Are we headed for the biggest crash since 2008? Is Wall Street about to crumble? And is this by design? We have answers for you on this special financial update.
I'm Gary Keesee, and for 9 years, we lived in a financial, chaotic, stress-filled, visionless life. I cried out to God. He said, "You're living like many of my people are, living in debt." He said, "I want my people free."
Your financial freedom is closer than you think. America's financial coach, Gary Keesee, shares the kingdom principles that changed his life, defeated his debt, and set him free.
Financial problems, they're slow death.
We're trying to change the way you think about money.
This is Gary Keesee, Fixing the Money Thing. Today, a financial update. Are we facing economic collapse?
Lines stretching down the sidewalk, banks closing their doors. You would think I was describing the Great Depression or maybe even 2008, but no, this is right now, friend. What I'm describing is a run on the Silicon Valley Bank, and we need to talk. And let's get into the fix. I'm joined today by Jay Plord, a Wall Street banker since the late 1980s, and my wife Drenda, the host of Drenda on Guard and the author of Fight Like Heaven. Wow, we have a lot to talk about, guys and gals. So, Jay, you come from Wall Street. I think most of us out here in normal land are like, what is going on, right? Tell us what's going on. I mean, what's the world coming to an end or what?
Yes, no, I don't believe the world is coming to an end, but, there's always, whenever you have events like this take place, and there's been, if we went back just in recent history, people would tend to forget that we had several major crashes even before what we experienced in 2010. If you think back to the dot-com bubble.
Yeah, 2001.
Yep, that was a big deal. That caused all sorts of problems. Just a few years before that, we had a major hedge fund blow up called long-term capital management. People don't remember that in the crisis that it created. But with each one of these crises that we go through, starting with the global financial crisis, the Fed and the government has stepped in with increasing levels of support for the market. Now, that is not the traditional form of economics. Economics would say that if you have a failing institution, you just let it fail. The government should not step in because you create what's called moral hazard by doing that. All of a sudden, people begin to believe that things are risk-free. The government will always have my back, and therefore I can take more risks. Now, the larger you become as a banking institution, the more likely it is that the government will step in because regular consumers are being hurt and regular consumers vote. And that's what they're concerned about. So when you have an institution like Silicon Valley Bank, it was the bank for the venture capital community in that part of California, Northern California. Now, even though it was global, they had 8,500 employees who all lost their job. Well, not all of them, I take that back. Some of them are going to be employed. But lots of people lost their jobs. They had offices all over the world. But they grew because they were very adept at funding venture capital companies and then funding the companies that those venture capital firms invested in. So I think over 50% of the startups in Silicon Valley had bank accounts at Silicon Valley Bank. And if you're a banker, I mean, that's a great success story. They had gone out and done they had an asset management division, they had regular banking, they had a securities division. They did all different kinds of businesses. And that's how it grew to be. I've heard two different numbers on this. They were either the 16th largest bank in the United States or the 20th largest bank, but they were definitely top 20. And they did that because all of these venture capital firms were going out and raising money all the time.
Right.
Well, when you raise cash, where do you put it? You have to put it in the bank.
Yeah.
So Silicon Valley Bank got lots of deposits. And then the companies they were funding, the startups, what do? They go out and raise money. And what do you do with the money you raise? They put it in Silicon Valley Bank. So they ended up with just, I think it was $230 billion worth of deposits. Well, traditional banking, whether it's a local bank, a community bank, or whether it's Silicon Valley Bank, you take that money that depositors give you and you reinvest it.
Sure.
That's the only way you make money, because you have to pay interest on that money that they give you, right? If you can take it out and invest it in something and make money on that at a percentage rate greater than what you're paying out to your depositors, that's called the net interest margin. And that's how banks make money. And so what Silicon Valley Bank did was they took the safe route. They looked at the pandemic, everything that was going on, and they took a lot of that cash, which I believe was, up to, I've heard a number as high as $130 billion worth of cash, and they invested it in treasuries. Now, those are treasury bonds. Safe government bonds. All of us would, no financial advisor would tell you that there's anything wrong with a U.S. government bond. People from all over the world, including foreign governments, buy U.S. government bonds because they're highly liquid, they're safe, and the U.S. government has never defaulted on a bond or a debt. Silicon Valley Bank bought those bonds, but the problem with bonds is interest rates go up, the price on the bond goes down. So you're protected. If you bought a 5% bond, you're going to get your interest payment. And if you hold it to maturity, you'll get all of your money back if you hold it to maturity plus interest. So that's no problem. So they were doing a very safe thing. However, when the Federal Reserve started raising interest rates aggressively last year, then the price of those bonds went down, and they went down a lot. So everything was fine. That's okay, because you're still going to hold the bonds till they mature.
Can I add something here just to help our audience? Why do the bonds go down? So you have a 5%, it's a fixed rate bond, and so interest rates are climbing. And I can buy a new bond for 7%, let's say.
That's right.
If you're going to sell your 5% bond, why would I want to buy your 5% bond if I can buy a 7% bond?
That's right.
So you have to sell it, we call it at a discount. Because I'm not going to buy your 5% bond unless you can bring it up to the same place I'm at here. And so that's what you're talking about, is they had these bonds fixed, rates are higher, people are going to buy these, not these. They have to sell them at a loss or at a discounted price.
And they wouldn't have had to sell them at all, except that all of these companies in Silicon Valley stopped depositing money. And the venture capital firms stopped depositing money because of what happened last year. And instead of depositing money, they started to withdraw money. Because they needed the cash.
It was an investor run. The investors were actually pulling their money and putting it in banks, in places they thought were safer, right?
They had to pay their bills. So if you're a startup and you're not raising capital, then you have to go out and you have to take money out of your bank account and you have to pay your bills, your payroll.
So it's not like people ran to the bank and grabbed their money out. It was more the investors moving them out, and then now the bank's in an upside-down position?
Yeah, pretty much. I mean, they all of a sudden the bank is saying, "Whoa, wait a second, we're not getting new deposits, and we have to raise money because we have to return this cash." Because the cash, treasury bonds are sort of cash. You can trade them so easily. But we've got to give these depositors, who are venture capital firms and startups, we've got to give them cash. So they were forced into selling the bonds at a discount. And they lost a lot of money, $1.8 billion. And then when word gets around, because it's a publicly traded company, they have to file quarterly reports to the SEC. And there's some very smart people out there that spend their entire lives looking at these government filings. And they saw that they were selling these bonds and they had a huge exposure to treasury bonds, and they got nervous. and they said, oops, we should maybe withdraw some of our money. So Peter Thiel, one of the top investors out on the West Coast, they took some of their money, and all of the companies that he had funded, he told them to take some of their money out of Silicon Valley Bank. And then word gets around, and word gets around, and word gets around.
Yep. Pretty fast.
Pretty fast. And that's the run that was precipitated, because they're forced into, it becomes a self-perpetuating cycle. You have to sell more of the bonds to get cash, to pay people, and then essentially your balance sheet, your own liquidity as a bank is threatened. So they had, it happened all very quickly, and within about 36 hours.
Wow, yeah.
And so the FDIC was forced to step in and take over the bank. Now, it's not, $230 billion wasn't lost. The majority of that money is still there, right?
In the bonds.
In the bonds, right? So it's not like the money evaporated. But the problem was the bank no longer had the ability to be an effective counterparty in the industry or to its depositors. So now the FDIC has come in, and in order, the latest announcements out of the Treasury Department out of Washington are, we'll make everybody whole.
Except the investors.
Well, the equity investors.
But not the investors.
The equity investors in SVB was publicly traded, right? So any publicly traded bank, you get wiped out if you're an equity investor. Yeah. Right. If you have debt, you're protected. If you own some of the debt, because banks can issue bonds as well, you're protected. But yes, equity investors, but not depositors. So depositors in this case are going to get all of their money back because of the actions the Fed has taken. Now, but what it created was fear, of course.
Right.
Now all of a sudden it's called the cockroach theory.
Yep.
When
where there's one, there's more.
When there's one, there's more. And so
there are.
Yeah, and so then, but because remember, before Silicon Valley Bank failed, just 2 weeks prior to that, Silvergate, a California bank tied up with cryptocurrencies, failed.
Yeah.
Right.
And now we have Signature as well.
Right,
and
the
others
3 S's, incidentally. So that may be interesting, but. So Silvergate failed. No one ever thought that would happen. Then Silicon Valley Bank, now Signature,
and
right?
Others are out right now.
Well, Credit Suisse. Yeah. Credit Suisse is under threat right now. All of these are big, substantial institutions with lots of money, and in Silicon Valley's case, it was bad risk management. It's called concentration risk. So when you've got $100 billion. How do you spread that out so that you always have enough liquidity when your depositors want their money back? You have to be able to sell things quickly. So you have to keep a certain amount in cash, even though you make no money on your cash. But because it was a publicly traded company, they always want to show a return to their investors, like we're growing our earnings and our profits. And the only way to do that is get money from treasuries or real estate or other investments that you make. Sure. And so it's bad risk management, and they just had too much concentration. It's similar. There are about 10 banks in the United States that have similar exposure, where they have a lot of treasuries. But now that the Fed has stepped in, it doesn't matter. The Fed is going to guarantee all depositors, and what they're trying to do in the Treasury Department, and what they're trying to do is just stop the panic so that no depositors will lose money. We don't need any more runs on banks. And Bank of America received $15 billion in new deposits.
And that's the concern right there, right? Because they're all running to the big 6, the banks that can't fail. Meanwhile, those investors are pulling their money out of the regional banks, the small banks, putting them into the 6 that can't fail. So there's a thought, and I think I make that point in Fight Like Heaven, that there are devious powers playing America for a collapse to get us into a great reset. So it would appear that even though the government will back the depositors, when all the investors pull their monies out of these regional and small banks, they begin to collapse and shut their doors, and now all the money's shifting to the big 6, which gives the federal government and those big 6 the ESG the credit, the whole scoring, the credit scoring, the digital currency setting us up for potentially a reset.
Well, bank stocks have been heading down, that's for sure.
Yeah.
And that's, going
So
to happen.
I can be the conspiracy theorist
Yes,
in
of course.
conversation.
Yeah.
But to me, sources I was looking at back in December were saying in the spring, we're going to have bank issues. There could be run on banks. There's going to be volatility that will give us a demand and cry for a great reset, a new system, the digital currency by June. Are we there?
Well, I think that people who were prognosticating this last year, Warren Buffett has always said that you never know who's swimming naked until the tide goes out.
That's right. That's a great statement.
He said that for years, right?
Yeah.
And the tide of rising, well, when interest rates rise, the tide goes out. All of a sudden you find out what easy money was funding.
2008, right? 2008.
Yes. And cryptocurrencies blown up, not Bitcoin, but cryptocurrencies have blown up. So that easy money or low interest or zero interest rate money was funding a lot of that.
A lot of stuff.
And Silicon Valley Bank, of course, that covered up mismanagement of the risk. I'm not saying anybody was doing anything evil or on purpose. I'm just saying that it was bad treasury management. But look, local banks are, if they're managed well, they're not going to have a run. I mean, local banks like Frost Bank Frost is within the state of Texas. They have no other branches outside of the state of Texas that I know of. And it's what I would consider to be a strong regional bank, very well run. They'll probably benefit from this because...
Would you say for people to put their money in regional banks? Well,
I would.
That's what we want to help.
We want to help the consumer.
Sure,
yeah.
absolutely.
So people are going, where do we put our money? Where? And we have some ideas and thoughts too. But what do you say?
I say that you've got to do a little bit of work. You can't just say, well, it's a regional bank, and therefore, because it's a regional bank, it's safer. They're not all the same. If you've got an institution that is well run, that's local. Then you still need to do a little bit of investigating about who's running it, what's going on there. When they're not publicly traded, it's a little bit more difficult to get information, but banks still have to file with the state authorities.
Charters, yeah.
Yes,
Charters.
and you can get information, and Google has made it so easy to go out and find information on just about anything or anyone now. There's no excuse for not doing a little bit of work. But I personally do not think that every local bank is going to get hit and gobbled up by someone else. I think there will be.
Pray not.
Yeah, I pray not too.
Yeah, that's dangerous.
There are a few that are probably, as in any industry.
Sure.
It's not just banking. There's always a few where there's mismanagement, and there are opportunists in any industry. And so in banking, I guarantee you that right now there are hedge funds. This is what they do for a living, incidentally. It's not that they have an evil conspiracy, but there are hedge funds and there are other investors out there who are looking for opportunities to go in and buy banks cheaply, combine them, and then have a bigger, stronger bank. Now, could they have an ESG agenda?
It's on their website.
They could. But my experience is with investors is they're commercial animals. They want to make money. So if the ESG label allows me to make more money because it's acceptable right now, it's popular, then they adopt the ESG label. If this woke environment that we're in helps them make more money because it's acceptable, it's popular, but the people that I know who are investors and who will go out and look at these banks and buy them, that's not what motivates them.
Money.
It's the money, right? Making money. They buy an asset cheap and sell it high. And that's what they try to do. And rolling up in any industry, you can roll, it's called a roll up, and you just buy and put them into one entity. Now, as you said earlier, there are a group of 37 institutions globally that have been deemed too big to fail by their governments, right? That essentially means that no matter what, the government is going to step in and make sure that these institutions continue to run. And 8 of them are in the United States, and they are the 8 biggest banks that we all know.
And they all pretty much have woke agendas, too.
Right.
Because of maybe what you're saying about the money and the connections with what's going on across the world.
Absolutely.
With the desire for the World Economic Forum talks about their Great Reset.
Yep.
You know, their New World Order. We heard it out of Biden's mouth last year. We've heard it out of other politicians in the past. It's just an interesting time to live in. Even Signature Bank in New York was the one that virtue signaled by closing Trump's account.
Yeah.
So there's definitely something in play here.
Sure.
And then you've got, of course, on the other side of that, you have people like DeSantis and others on the right side of things that are using that to say we're anti-ESG. Florida banks, we're not going to allow that to be, which is why we maybe consider, we considered in the past, we've put some money in Florida in a charge of banks because we feel like, hey, we know their politics. So would you say, when you're considering a regional bank, does the state charter and the politics of that state, does that give you some I know Texas leans a little bit more in that direction as well.
Sure.
Does that make a difference too? Because I know when I looked at the one bank, I said all these ESG, all these equity, all of these claims and things they were making their front page. I said, not putting my money there. Because one, I don't want to support those agendas. Two, I don't trust people who drive those agendas in that corporation. That tells me something about their management. So anyway.
Okay.
I know that's a lot.
Well,
those
the
are
thing
loaded
is-
questions, I know.
The thing
and
is
we want to
that
tell
they're
people
gonna-
where they can put their money safely.
Yeah,
Sure.
But I was going to say the thing is that when you open up the advertisement for these institutions that are selling a product, it be investments or whatever,
Sure.
and you don't see the product to the 10th page that they're marketing, you wonder where the shareholder comes in
Yep.
Right,
and
right.
benefits
That's the
from this whole thing and how much they're
looking out for equity more than they're looking out for shareholders, yes.
You're looking out for other things, spending money, other things,
Yeah.
making decisions based, including other things that maybe the shareholder or anyone who wants the product would prefer to have a return more on their side than to spend the 10 pages marketing what the bank wants to market besides what
Sure.
they do.
Yeah.
And so that's where we see happening now. And this has been a big discussion this week in the papers. I saw
yes.
that.
Yeah.
That President Biden was wanting to put this ESG into policy by executive order, that they had to consider this for investment retirement accounts and some stuff. And of course, thank God people are standing up against that. But nevertheless, you take your focus off of shareholder returns, then we've lost our viewpoint as a country of what it means to be an American, that we can build and grow and we can trust this enterprise to represent us and to gain the best pricing that we can get. And they're not working just totally for us. So
That's right.